Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. The word extremely in the title is a kind of pun, because the stories represent extremes of various sorts that were manifest on Wall Street in recent years. They hold instruction and grave warnings for everyone who has a serious connection with the world of stocks and bonds, not only for ordinary investors and speculators but for professionals, security analysts, fund managers, trust account administrators, and even for bankers who lend money to corporations. The 4 companies to be reviewed, and the different extremes that they illustrate are: Penn Central Railroad Company. An extreme example of the neglect of the most elementary warning signals of financial weakness, by all those who had bonds or shares of this system under their supervision. A crazily high market price for the stock of a tottering giant. Takeover Vault Incorporated. An extreme example of quick and unsound empire building, with ultimate collapse practically guaranteed, but helped by indiscriminate bank lending. NVF Corporation. An extreme example of one corporate acquisition, in which a small company absorbed another 7 times its size, incurring a huge debt and employing some startling accounting devices. AAA Enterprises. An extreme example of public stock financing of a small company, its value based on the magic word, franchising, and little else, sponsored by important stock exchange houses. Bankruptcy followed within 2 years of the stock sale and the doubling of the initial inflated price in the heedless stock market. The NVF takeover of Sharon Steel, a collector's item. At the end of 1968, NVF Company was a company with $4.6 million of long-term debt, $17.4 million of stock capital, $31 million of sales, and $502,000 of net income before a special credit of $374,000. Its business was described as vulcanized fiber and plastics. The management decided to take over the Sharon Steel Corporation, which had $43 million of long-term debt, $101 million of stock capital, $219 million of sales, and $2,929,000 of net earnings. The company it wished to acquire was thus 7 times the size of NVF. In early 1969 it made an offer for all the shares of Sharon. The terms per share were $70 face amount of NVF Junior 5% bonds, due 1994, plus warrants to buy 112 shares of NVF stock at $22 per share of NVF. The management of Sharon strenuously resisted this takeover attempt, but in vain. NVF acquired 88% of the Sharon stock under the offer, issuing therefore $102 million of its 5% bonds and warrants for 2,197,000 of its shares. Had the offer been 100% operative, the consolidated enterprise would, for the year 1968, have had $163 million in debt, only $2.2 million in tangible stock capital, $250 million of sales. The net earnings question would have been a bit complicated, but the company subsequently stated them as a net loss of 50 cents per share of NVF stocks, before an extraordinary credit, and net earnings of 3 cents per share after such credit. First comment: among all the takeovers effected in the year 1969, this was no doubt the most extreme in its financial disproportions. The acquiring company had assumed responsibility for a new and top-heavy debt obligation, and it had changed its calculated 1968 earnings from a profit to a loss into the bargain. A measure of the impairment of the company's financial position by this step is found in the fact that the new 5% bonds did not sell higher than 42 cents on the dollar during the year of issuance. This would have indicated grave doubt of the safety of the bonds and of the company's future. However, the management actually exploited the bond price in a way to save the company annual income taxes of about $1 million, as will be shown. The 1968 report, published after the Sharon takeover, contained a condensed picture of its results, carried back to the year end. This contained two most unusual items. 1. There is listed as an asset $58,600,000 of deferred debt expense. This sum is greater than the entire stockholders' equity, placed at $40,200,000. 2. However, not included in the shareholders' equity is an item of $20,700,000 designated as excess of equity over cost of investment in Sharon. Second comment, if we eliminate the debt expense as an asset, which it hardly seems to be, and include the other item in the shareholders' equity, where it would normally belong, then we have a more realistic statement of tangible equity for NVF stock, viz. $2,200,000. Thus the first effect of the deal was to reduce NVF's real equity from $17,400,000 to $2,200,000, or from $23.71 per share to about $3 per share, on 731,000 shares. In addition, the NVF shareholders had given to others the right to buy 312 times as many additional shares at 6 points below the market price at the close of 1968. The initial market value of the warrants was then about $12 each, or a total of some $30 million for those involved in the purchase offer. Actually, the market value of the warrants well exceeded the total market value of the outstanding NVF stock, another evidence of the tail-wagging dog nature of the transaction. Indeed, amortization of equity over cost of investment in subsidiary, Cr. $1,650,000. In one of the footnotes we find an entry, not appearing in any other report that we know of. Part of the stock capital is there designated as fair market value of warrants issued in connection with acquisition, etc., $22,129,000. What on earth do all these entries mean? None of them is even referred to in the descriptive text of the 1969 report. The trained security analyst has to figure out these mysteries by himself, almost in detective fashion. He finds that the underlying idea is to derive a tax advantage from the low initial price of the 5% debentures. For readers who may be interested in this ingenious arrangement, we set forth our solution in Appendix 6. Other unusual items. 1. Right after the close of 1969, the company bought in no less than 650,000 warrants at a price of $9.38 each. This was extraordinary when we consider that NVF itself had only $700,000 in cash at the year end, and had $4,400,000 of debt due in 1970. Evidently, the $6 million paid for the warrants had to be borrowed, it was buying in this warrant paper money at a time when its 5% bonds were selling at less than 40 cents on the dollar, ordinarily a warning that financial difficulties lay ahead. 2. As a partial offset to this, the company had retired $5,100,000 of its bonds along with 253,000 warrants in exchange for a like amount of common stock. This was possible because, by the vagaries of the securities markets, people were selling the 5% bonds at less than 40 while the common sold at an average price of 1312, paying no dividend. 3. The company had plans in operation not only for selling stock to its employees, but also for selling them a larger number of warrants to buy the stock. Like the stock purchases, the warrants were to be paid for 5% down and the rest over many years in the future. This is the only such employee purchase plan for warrants that we know of. Will someone soon invent and sell on installments a right to buy a share, and so on? 4. In the year 1969, the newly controlled Sharon Steel Company changed its method of arriving at its pension costs, and also adopted lower depreciation rates. These accounting changes added about $1 per share to the reported earnings of NVF before dilution. 5. At the end of 1970, Standard & Poor's Stock Guide reported that NVF shares were selling at a price-earning ratio of only 2, the lowest figure for all the 4,500-odd issues in the booklet. As the old Wall Street saying went, this was important if true. The ratio was based on the year's closing price of $8.34 and the computed earnings of $5.38 per share for the 12 months ended September 1970. Using these figures, the shares were selling at only 1.6 times earnings. But this ratio did not allow for the large dilution factor, nor for the adverse results actually realized in the last quarter of 1970. When the full year's figures finally appeared, they showed only $2.03 per share earned for the stock, before allowing for dilution, and $1.80 per share on a diluted basis. Note also that the aggregate market price of the stock and warrants on that date was about $14 million against a bonded debt of $135 million, a skimpy equity position indeed.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.